VC perspectives on record fundraising by Indian startups. We've witnessed about $28 billion of infused into Indian startups last year, and it's been a friendly year, frankly speaking. So, interesting perspective because there's a lot of volatility in the market. Interest rates are inevitably going to be high, so liquidity will be less. So, how 2022 unfolds and experiences from how 2021 a record year has been. So in this panel, I would like to welcome Mr. Ankur Pava, who is e-commerce and consumer internet leader, transactions diligence partner UI India, on stage to moderate the panel. Hi, Ankur, welcome. And what we'll be doing is on this panel, we missed out on Sai from Bain, because of a technical glitch about half an hour back. So we'll be having Sai also as part of this panel so that, from a numbers perspective, she could actually draw out the trends and opportunities for 2022. So can we have Sai also on stage from Bain and Company?
Thanks, Rohan.
Yeah, aside to Sai and Ankur, from a panelist perspective, we'll be joining by Ashish Wadhwani, Managing Partner, Ivy Cap Ventures, Mr. Karun Karyappa, Partner, Corporate and Commercial Mergers and Acquisitions, Khetan and Company, Mr. Prashant Prakash, Founding Partner, Axel India, Mr. Rajesh Sehgal, Founder and Managing Partner, Equanimity Ventures, and TC Meenakshi Sundaram, Founder and Vice Chairman, Chirate Ventures. Welcome to the panelists as well.
Thank you.
Thanks, Rohan.
Hi, Rohan.
Hi, welcome. Over to Ankur. Why don't you start the moderation? Thank you so much for doing this.
Not at all, Rohan. Thanks so much. I think it's a pleasure. I think it's a fantastic bunch of people, and I think they're seen this ecosystem over so many years, more than a decade, and I think it's been interesting times that we've seen, especially over the last couple of years. Sai, maybe we'll just start with you. I mean, I think we're talking about a large set of investments that have gone in CY21. Lots of interesting themes that sort of emanate from there. But why don't we just start off with you, just sharing what are some of the key things that you've seen in the last calendar year that would be interesting as we unpack the 30 billion plus investments that we're talking about.
Yeah, absolutely. Thank you, Ankur, and glad to be here, and look forward to sort of speaking to this August group over the next few days. Ankur, to your question, if I sort of summarize the last year, as we're all aware, 2021 was a pivotal year for the Indian VC landscape. And to many, it feels like this was sort of several years in the making, right? There's several set of sort of strong tailwinds that have converged together to make this unique investment climate in India. And if I just sort of note a few, right? One, sort of several infrastructural fundamentals across, eKYC, Aadhaar, UPI-led payment rails, cheap ubiquitous data. So sort of platformization of the infrastructural layer. That, along with increasing depth in the Indian startup ecosystem, across the range from Bharat First models to building in India for global scale, and easing sort of regulatory restrictions that have led to unlock of long-held capital. All of that, together with sort of regulatory crackdowns in China, to some extent have sort of redirected capital to India and also to rest of the Southeast Asia. So all of that sort of led to this sort of very unique moment in India over the last year, leading to that sort of 38.5 billion USD in VC investments in India. And if I just sort of reel off a couple of highlights there, one, I think, is the first year where VC investments as a portion of total PE-VC investments exceeded more than 50% in India. Number two, sort of VC investments grew at 3.8x over 2020, much faster than China, which was at 1.3x, and global investments were at about 1.9x. So again, very, very rapid growth. And finally, sort of 44 unicorns were minted in India in 2021. Again, for the first time, more than China in a long time. So, and the other sort of unique angle to this is also the investment growth was not only sort of deal volume, which also expanded almost 2x from 800 to 1500 plus, but more importantly, deal size, which grew from about 12 million to more than, sort of reaching that coveted number of 25 million average deal size, and sort of secularly that sort of stands across, deal stages. So I think that sort of is sort of the overall perspective. And if I just take a few minutes to talk about how it looks from a sectoral perspective. Consumer tech, fintech, SaaS obviously continue to dominate the investments. At more than 75% investments went into those sectors, but we saw a few emergent themes that were really interesting. To sort of start off within consumer tech, several alternate commerce models emerged. So think video commerce players or grocery retailing, etc. Short form video, another billion plus went into the globally popular D2C aggregation model as well, and obviously minted one of the fastest unicorns in India. A few other areas, online B2B marketplaces also saw 4 new unicorns being minted. Fintech had a record year with 5 billion plus in funding. Again, neobanks led the way there. But also want to call out that Web 3.0 and crypto-based startups also saw a very unexpected kind of a growth. With 40 plus deals, 100 million plus in investments. So very very significant set of emerging themes across a lot of these, secularly across sectors, and even in the sort of tail sectors. On the fundraising side, again, I think we saw a lot of activity from seed funds, family offices. There are now 85 plus, seed funds and micro VCs in the country, 150 plus active family offices, which is phenomenal. And more importantly, 2021 was also the year of sort of alternative, younger, smaller funds raising new capital. More importantly, also deploying that capital. So we saw tier one crossover funds like a couple of, and please excuse names here. I don't want to point at names, was just sort of take an illustrative list. We saw TCV or Dragoneer or AlphaWave sort of make large investments. Domestic funds saw an increasing significance. A lot of domestic funds, sort of invested very significantly. Then we just spoke about corporate VCs as well, but also sector-focused global funds kind of double down on India. Ribbit Capital in fintech, or DSG in consumer tech, or Coinbase Ventures in Web 3.0. And the second sort of interesting trend within that is we also saw sort of convergence with private equity funds starting to look at growth equity more significantly. And lastly, I'll just say that it was a defining year for exits. Obviously, secondary transactions still made up for sort of 60% of the 14 billion in exit value, but IPOs across with the SEBI sort of relaxing norms for tech-led firms, Zomato, Policy Bazaar, etc. The exit momentum was phenomenal, in first time ever for the Indian landscape. And just sort of close that out in terms of outlook, our view on the outlook for 2022. We've already seen 11 unicorns, 8 billion plus already invested across 300 plus deals, still again at an average deal size of 25 million. So we believe that investment outlook for 2022 may remain in line with 2021 potentially, because of dry powder availability as well as a depth of assets in the ecosystem. But we also envision a shift in the pace and the quality of deals. So we expect that investors will double down more on quality assets, larger rounds, more measured pace of deal making, and some of the sort of global headwinds in the public markets will have a trickle down impact, with some degree of rationalization on valuations. So that's sort of our summary, but happy to kind of lend the stage to the more luminaries here.
No, thanks, Sai. I think great context, and I think it certainly helps us sort of take forward some of the discussion items that we'd like to cover as well. Let me just dive in. Maybe Rushant, let me start with you. Firstly, congratulations on the new fund that's been set up. I think in the backdrop of some of what we've heard, it's certainly CY21 really has been like a zeitgeist moment for startups, consumer internet businesses, with the kind of funding, the rounds that we've seen, etc. Qualitatively, what do you think has really been a couple of reasons why this has happened, outside of just some of the other factors that we've discussed, be it the founder quality, be it how businesses have been built qualitatively over the years, Prashant. So, would love to get some thoughts from you on that. Prashant, sorry, you're on mute. I don't think we can hear you.
Can you hear me?
Yes, Prashant, thanks. Okay.
Sorry. So I think a lot was covered in the last few minutes. I think in terms of really what enabled some of the momentum this year. But there's probably a couple areas that I think really stand out. It was spoken about. I think the depth of the ecosystem. I think one was the depth, but I think the breadth of the number of sectors that entrepreneurship is or startups are kind of impacting today. I think that went through a dramatic shift in the last 18 months. It was not just B2B, right? Once entrepreneurship started impacting B2B, it was manufacturing, it was everything in supply chain. It was once you started looking at agri, it was the entire 100 million families who were either untouched by startup entrepreneurship. That started triggering, right? And once you started impacting, agri, you started impacting various fintech aspects in agri-tech, which because of the lack of data, so there was this new areas which entrepreneurs ventured into, because SaaS had already happened before. So in the last 5, 6, 7 years. So really the kind of pioneering into areas which were either too untouched by startups, so to speak, I think was the big shift. And I think we have spoken enough about the make in India for the rest of the world kind of story in product over the years. But I think in the last 18 months, again, those companies got to some critical mass. So you started seeing $200-300 million revenue. And these companies also were the companies that took a lot less capital compared to other consumer companies here in India. So there was a doubling down on SaaS like never before. So in fact, so we just looked at some data. I think SaaS in these SaaS companies had almost a 6-7x growth in just these 18 months. So consumer was already there, just phenomenal growth in SaaS and new areas such as B2B and beyond urban India kind of commerce. I think was really what changed a lot.
No, excellent points, Prashant. Makes a lot of sense. TCM, obviously back on the road. You're at the airport, so clearly activity is up and about. What your thoughts on the year behind TCM? How's it been? And again, congratulations to you as well on the fundraise that just happened. TCM, you're on mute as well in case you're saying something.
Can you repeat the question once, Ankur?
Yeah, no. I was just saying that you're at the airport, so clearly activity at full swing for you. Just also curious to get your thoughts on the year gone by. You've obviously been seeing the ecosystem again for over a decade. You've seen multiple cycles. How do you see the CY21 vintage from your perspective?
Yeah, I think last 2 years after COVID has been a tailwind event for technology companies, right? Technology startups, where the adoption got accelerated even in situations where it was not. That has led to also liquidity being there, and these two, coupled with, I would say, public market euphoria on technology, and also the FOMO, I would say, in terms of saying that, okay, let's get into these, has led to a significant traction. See, end of the day, India adoption has gone up multifold, right, across the sectors. Whether it is consumer level, where it has reached people whom we would not have expected to possibly onboard till 23, 24, they got accelerated by at least 2 years. And so there has been a, so money has been following that. Um, I think it's been a great year, but we need to see what going forward.
Thanks, TCM. Appreciate that. Ashish, let me ask you. I think we were speaking about some of the sectors. As I also said, we've seen a lot of action, obviously on the fintech side. We're seeing direct to consumer. Prashant obviously spoke about SaaS as well. And then I think just putting the point that TCM raised as well. It may seem that a lot of the velocity of investing, the frequency of rounds, the liquidity fueled valuations as well. So two questions: your thoughts on the top two three sectors and the drivers of that, and two, do any of these sectors, from your perspective, have a FOMO liquidity led valuation bubble that we need to worry about as we think about the next couple of years from a more sustainable perspective? Ashish, sorry, you're on mute as well.
I think some of these sectors will continue to remain interesting. I think on the consumer side, even on the fintech side, I think a lot different aspects of fintech. We saw a lot of lending, etc., well tech, but a lot different aspects of fintech will emerge. On the consumer side too, I think there's lots of niches, lots of different types of plays, new channels, or new methods of commerce coming up. So we see lots of deals on that side. Some of the larger sectors, edtech has been hot, but it's been difficult. Agri-tech also is very large, but obviously difficult, not easy to build. But I think patient investors will be able to sort of create good companies, and patient founders, of course, will be able to create good companies in this space. In terms of a bubble, I think I'm not sure that CY22 will kind of more or less be on a straight line to CY21. It looks like a completely different trajectory. I think the tech public market signals in the US are very clear, and I think that's going to percolate very fast, down the chain. Of course, there is a lot of dry powder, but I think investors will become a little bit cautious. We don't know what's happening on the Fed side, what's happening with the war, etc. So I do see some challenges in terms of the sheer euphoria or the valuation levels and the speed of deals that happened last year as compared to like going forward. But having said that, ours is the long-term industry, right? I mean, we do go through these cycles of euphoria and some correction. I am extremely bullish over the next 10 years of this space for patient investors and good founders who want to build really good businesses. I think there's tremendous potential. So yes, there may be some corrections, but I would say more companies and more winners coming out of India in the next 10 years for sure.
Absolutely. I think we've seen the resilience and the innovation that Indian entrepreneurship has been able to work with, especially over the last few years. But I think Ashish, thanks for those inputs. I think a lot of FY22 and beyond perspectives, and I'll come to that separately as well.
Karun, just one point, if I may add from a founder perspective, I think there's still a lot of euphoria about the amount of capital and the valuations you can raise at.
But ultimately, I think how you use that capital and how you build you can't fast forward business growth by simply increasing valuations, right? So how you use that capital and deploy it is, I think, most critical, particularly in times of boom, because you can make bigger mistakes in times of boom than otherwise.
Absolutely. No, no, good point, Shichan. And let's pick that up, as well shortly. Karun, we've been speaking a lot about VC investments, but clearly seeing that, new forms of financing, well, venture debt, not necessarily new, but, we're seeing that that's picking up. It's probably doubled, close to $500 million plus of venture debt in CY 21. We've seen revenue-based financing funds also being set up. How do you see these alternative forms of capital, competing with or supplementing the more traditional forms of capital that we have? And I guess the second part of that question really is, in spite of all the inroads that have been made, our proportion to VCP investment in India to venture debt is still relatively low. It's 2% or less. More mature ecosystems, are probably 10x plus, of that. The US is 20% plus. Some of the other markets, within that same zip code. How do you see that evolving, and any regulatory pressures or other areas that you think could help, accelerate this segment of the market as well?
No, great question, Ankur. Thank you very much for having me here. I think venture debt is quite an important capital instrument for young founder companies. In India, I think we've seen about 600 million of venture debt in 2021 compared to 2019, where it was about 300 mil. In the US, you have banks and other lenders also who contribute to debt, as a result of which you've got that 10x over what you have in India. In India, it's still 2%. It's still quite a small portion of the 35 billion of equity capital that was raised in 2021. I think from the founders' perspectives and also from young startups' perspectives, I think familiarity of venture debt is important. I mean, you look at the advantages to the companies. From a valuation perspective, there's no real valuation hit. These are underwritten on the basis of future revenue potential or existing equity funding. Equity dilution, very minimal. Sometimes you'll have an equity kicker in the form of warrants or the rights to subscribe to equity at a later date. So dilution is minimal. Investment period is typically 1.5 to 3 years. Coupons with the equity kicker, it's about 12% to 15%. Without the equity kicker, it's at about 20%. So it's kind of it's higher. In terms of due diligence, also these deals can be done super quickly. Lenders come off the back of the strength of the cap table, and they come off typically when fresh equity has been raised. And security packages, they're typically the securities over current or future assets such as intellectual property or brands, or sometimes you get a promoter giving guarantee or corporate giving guarantee, depending on the strength of the promoter or the corporate that's behind the startup. Now, in terms of regulatory aspects, and this may be one of the reasons why we don't have as much venture debt as other more evolved jurisdictions. In India, unfortunately, most of the venture debt has to be a resident entity. And there's primarily regulatory reasons for that. There are restrictions, if you come in as an ECB, there are restrictions on end-use funds, all-in cost ceilings, that is the maximum return that can be provided to the lender. There are restrictions on that. Minimum maturity of the loan also makes this route commercially unviable. When you have these equity kickers as well, warrants for non-residents, there's 25% which needs to be made upfront, and then it needs to be fully paid within 12 months of the issue. We don't really see any regulatory changes on the anvil in the coming months, but I think ultimately you're going to see a lot of sophisticated founders, and these sophisticated founders will be comfortable with debt, and with the no sort of dilution in equity, I think you're going to see a lot more of these instruments. And then from a venture debt fund perspective, getting a 12 to 15% plus an equity kicker, I mean, that's pretty good returns.
Absolutely, and I think these alternative forms are certainly going to become more mainstream. As we spend 22, 23 onward. Rajesh, I think we've spoken a lot about what's happened in 21. We've looked at early signals from 22. Obviously, have been phenomenal. We've again had within the last 10 weeks probably a unicorn a week, keeping pace. In fact, accelerating from what we saw in 21. $7-8 billion deployed, within this time period. But then there is a bit of winter coming. It looks like, with liquidity tightening, with the geopolitical situation that it stands. If you look at more market factors, with an impending IPO with LIC, liquidity from is going to get sucked out even from public markets. And while you've seen public valuations, public expectations, correct over the last few weeks. Again, some of these are external factors. Some of these are also factors of how people have looked at digital businesses. How do you see FY22, panning out? And what do you think are really a few key themes that you expect that will emerge over the next 10 months, in this calendar year?
Yeah, no, thanks, Ankur. Thanks for having me, first of all. And thanks for asking me the simplest question of all about the future. But I'll tell you, as much as we all indulge in crystal ball gazing all the time, because, apparently we are all in the business of imagining a future and then funding it. So let me step back to the whole ecosystem. You rightly mentioned a few concerns that the markets today and investors today have. And we are all familiar with all the concerns about, interest rates going up, liquidity being sucked out, the whole commodity complexes in a stratospheric level, Russia, etc. So I think all of it is known, and that actually leads me to believe from past experience that when most of the risk factors are known, I think all of us adjust to it very quickly and very fast. So even as we are in the middle of in the thick of all these troubles, and we all think, oh, it's bad, and markets are giving you the same signs. You open your Bloomberg and everything is red. And you look at all other markets, everything seems to be red. I'm much more optimistic now than I was a few months back. I think till about a few months back, this whole scare about liquidity just disappearing was a big scare. We've seen. I'm not going to comment on the number of unicorns, whether there'll be more than last year or not. No one knows. But I think there is a dose of reality that all of us have now, got firsthand. I think last year was just a complete runaway. It was the perfect situation. Everything was fine. Nobody saw any risks whatsoever till inflation started rearing its head, early last year. So I, just to summarize, I think we are in the midst of a lot of risk factors that have made themselves very, very transparent. The only reason why this year may not be as good as last year that I can think of is if a new unknown appears from somewhere. But I think the knowns that we are all battling with today are, we'll all adjust to it super fast.
Thanks, Rajesh. Certainly interesting perspective. And the way we've adapted over the last 2 years, if that's anything, I'm sure, this is again cyclical, and longer term, this comes back. Ashish, I want to just, double click on a point that you had made earlier about founder quality, founder thinking, and, how do they look to engage in some of these environments. And I just want to preface that, what Rajesh has said about the nature of the markets, as things stand. There is a lot of knowns already. What's going to happen. Clearly, things will get slow. There will be a certain set of or segments of companies which will be able to attract capital just by virtue of either the qualitative side of it, the market side of it. Then there'll be some, who may not be able to attract the right type of capital, just given some of the macro headwinds that would be there. From a founder perspective, how do you think their playbook needs to change over the next 12 months, if at all, or really is it business as usual, from their perspective as well?
No, I think the founders will pick up the signals that the investors are giving them or the market is giving them. and the speed at which you founders adapt will be I think one criteria of their success in going forward. I mean, uh, if you look at I mean, the again, as I said, the it's easier for the financial markets to adapt quickly in terms of deal making, valuations, kind of things you're after. But it takes longer for business, the right kind of business to be set up. For instance, even if you are raising, say, 10 million in a Series A round today, it doesn't mean that you can fast forward that much your product market fit or create a channel that fast. So I think there is, particularly when what we are seeing and in our discussions is sometimes when a lot of capital is available and it's available at rich valuations. I think founders tend to gloss over the very basic things about product market fit, what's my unit economics, how do I set up my channels, and assume that they can sort of blow past this with another round and another round, right? I think that may happen for some founders and some very hot areas and good companies will obviously get a lot of capital. But at the same time, that can't be taken for.
No, interesting thoughts. Interesting thought, Ashish, and certainly a few things to take away from as founders who are building these businesses. Prashant, newer areas you think which are going to emerge in CY22? We've spoken about. I think Sai gave a quick purview of what their view was, but lots of more complex words coming through the ecosystem. In general, what are some of the two three themes that you think will play out more in this calendar year than before?
So I think, yeah, Saib did mention the current, the B2B, the SaaS, all these are kind of going to continue to flourish in some sense in this year. But very interesting new trends, and some of it will be early seed. So I'll kind of separate it into uh, the Web3 and crypto space momentum. I think it'll overtake most other sectors this year. So when we're sitting here same time next year, we'll be surprised how much of this digital currency space has overtaken everything else in this world, right? So I mean that's how things work. I mean when they start inflecting, they inflect to an extent that nobody really would have imagined what the inflection would be. So and this is across the board in Web3. It's not just NFTs or DAOs or I mean, just I think it's across protocols, across tools to migrate, tools to build in this new Web3 world. So across the board, you will see, and it's a challenge and an opportunity for Indian founders because it's unlike SaaS, you kind of have some India advantage. There is lower cost of talent, easier to get bootstrap. In Web3, there is no real India advantage, right? It's as global as you can get. There is nothing. There's no country boundaries or anything, right? So it's a very interesting challenge. We'll have to see how Indian entrepreneurs really make it to this new world and what will be their place in this world. So that's a whole nother discussion for another panel on where Indian entrepreneurs will end up in the Web3 world. The other sunrise sectors, I mean, unfortunately, these have been sunrise for some time, but I think they're not one of them, which I'll talk about. But deep tech, whether it's space tech or other forms of Can you hear me?
Yes, Prashant, please go ahead. Sorry, Prashant, can't hear you now. We could hear you before. Prashant, I think we did get a good gist of some of the new areas that are going to emerge, and I think deep tech, which is what you were talking about, before you seem to get cut off. I think it's clearly an interesting area. I think the aspect of Web3 and the use cases that are emerging, broader metaverse, etc. I think those are all interesting themes, and we'll see how that pans out. Just moving on to, I guess, another key trend that I think Sai also brought out. I think TCM. Let me ask you. Um, we saw 10 billion to 14 billion, depending on where you count. PayU, do you count it as an investment versus do you count it as an M&A? But about 10 to 14 billion dollars of M&A consolidation. We saw. We are clearly seeing digital ecosystems are becoming more mainstream and have been over the last 2 years. How do you think this entire aspect of build for scale is going to play out in this calendar year? PC, I'm sorry, you're on mute. PC, can you hear us?
Ankur, you are asking me to speak?
Yes, TCM. I was asking you, how do you think consolidation as a theme will play out in CY22?
Yeah.
We've seen 10 to 14 billion dollars, whichever math you look at it. How do you see
Yeah.
that panning out in CY22?
So there are two important things, right? As the bar goes up in 2022, um, I think one of the challenges, nothing to do with the internal factors of the company, but would be in terms of challenge in raising funds. The market leaders will get a disproportionately more capital, and those who cannot will struggle to raise capital. So that's going to become an interesting opportunity for consolidation, right? Consolidation vertically in the same sector, adjacencies, those are going to be very interesting. As we speak, at least three of our companies are already having opportunities that they are evaluating to acquire others, right? Um, that will happen. Similarly, there are a lot of IPO bound companies or listed companies which are sitting with the currency to be able to acquire, and this is a great opportunity for them to consider. Obviously, um, as usual in markets like this, there could be a bit of a overdoing of everything. But other than that, I think this is a great year to be looking at consolidation as an opportunity.
And I think TCM makes sense, and we've clearly seen, right? I think as some of the more traditional businesses look to get digital, some of the acquisitions that have happened, both of larger companies and people, as you think about acquiring tech, I think that's playing out and will continue to play out more aggressively, as you said. And I think as people are looking to build adjacency of service, people are looking to build, get into adjacent markets. I think certainly it is something that will accelerate, very quickly. Rajesh, IPOs again, hard to have a discussion on CY21 without talking about IPOs. I think people have learned more about these digital businesses, and being able to sort of see them on the bourses, I guess itself has been something that has been an interesting outcome in CY21. Uh, there's obviously much talked about understanding or lack of understanding, if I can say, of business models, of profitability, path to profitability, cash burns, etc. But in spite of that, I think there is a lot of interest that the ecosystem has seen in the last calendar year. Um, Despite some of the headwinds that we spoke about, and you are obviously continue to be optimistic about what the next couple of years will be. How do you see the IPO market reacting over the next 12 months? And again, LIC is a big IPO coming up this calendar year, and that is going to have a lot of elements of dynamics that will play out as companies sort of look to list. Rajesh, your thoughts there?
Yeah. No, I think, like TCM mentioned about consolidation, and in this year is going to be a huge opportunity for that. I think for IPOs as well, 22 might end up being a good year for IPOs as well. And a few reasons to that. I mean, again, we all know the concerns out there. There's a mammoth IPO coming up, LIC, that will suck out liquidity, etc., etc. But I think you got to dissect the public markets, a little differently. So investors who are looking for investing, most investors, large investors, institutional investors, who will invest into LIC, I don't think are the same guys who will invest into, a digital tech company with no profits, some revenues and huge burn. I mean, it's just a very different mindset. And this difference in mindset was very glaringly seen by all of us, in terms of all the IPOs that happened last year. So most of the star IPOs that happened last year are down half, 50%, one third from where they actually listed or even offered their shares. Most of them. The best performing IPO, Nika, is up for 20% from the issue price. So there's really not much understanding of these new age business models with public market investors. I think that is the lesson that I took home from 21. So how do we address that? And I've been very vocal about this. I think it's up to each of us, all of us here on this panel and the companies that we invest in, to educate the public market investors about how to evaluate these business models. You cannot use the tools that you use to value mature businesses and just use the same toolkit with some little bit of adjustments and say, okay, now I'm going to try to apply this to new age digital technology companies. It just doesn't work. Yeah. So I think all said and done, the excitement that retail investors in India have, and retail is, by the way, a huge, strong, big force in the Indian markets. Over the last few years, we've seen, despite all the FII selling in the public markets, it's all been absorbed, very smartly. If you look at even 5-10 years back, so much selling in the Indian markets by FIIs, the markets would have just like tanked, like you see what happens with Taiwan or South Korea. So I think retail investors are a good force to reckon with, and the excitement to participate in this whole digital shift, which is a generational shift that we are all undergoing, is really very high. So I don't think there'll be a huge problem in IPOs coming to markets, but valuations, and we all have seen what happened to valuations of listed companies, listed digital companies. I think valuations, we'll have to be mindful of that. Just because we priced a company at a few $1 billion in the private markets, it does not mean the public markets will respect that. Public markets have very different participants than the private markets, and I think investment bankers, investors like us, and the founders, all three of us will have to get our arms around this to make sure that what we offer to the public is explained well to them. So the teach-ins that we have to have for public market investors, I think we all should dedicate a lot of time and effort into that. But I think the primary responsibility of ensuring that all these companies that all of us have in our funds, which are IPO ready, some of them have already filed DRHPs, etc. Most of them have appointed bankers to file DRHPs. Whatever stage you are in, I think it's our responsibility to start investing the public market, folks, about how to look at these companies. Other than that, I don't see a big risk. The IPO window is open, and I don't see any let down in terms of activity, despite all the global concerns that we spoke about in the beginning.
Well, thanks, Rajesh. Ashish, I'm conscious of time. We've spoken a lot about money and economics. I think one last question, as you think about, from a investor's perspective as well. What about the social side of this, right? Where does ESG come into it? How do we think about, D&I as an aspect of creating, more breadth in the ecosystem? Your thoughts on how funds and VCs in general, are looking at this in a broader context?
I think there's a lot of money out there which is focused on ESG and similar themes, and I think so far historically they have been like sort of separate paths, but I can see that a lot of investors overseas look for companies who are socially responsible, and that really is some kind of a meeting point uh, for the for that kind of capital coming in, becoming more mainstream, right? So I think again that it's going to be led uh, by the LPs and demand for that, and I think a lot of that will give rise to new sectors certainly on the renewable side, sustainability side, uh, agri-tech side, uh, but also perhaps at the company level, companies, let's say even in the consumer space these days, have offerings are attracting consumers with sustainability themes. So it gets built into business models. And therefore, for an investor, once your LPs are looking for some kind of a ESG angle or a sustainability angle, and once you have your companies building on business models for that theme, I think we are going to see a lot more of that, and it's for us to follow and see who's going to lead in that way, and look for the winners who are able to wed returns with social responsibility.
Well, thanks, Ashish. Very well put. And I think, as you also said, there is an opportunity, and I think it's great that capital can also be deployed, to some of these things. Karun, I do want to ask you this because, and again, short of time, so you can just be as concise as possible. I think everyone's been talking about direct listing SPAC. We've been hearing it, and last year especially, it was like everyone was thinking SPAC is the easiest thing that they can do. Reality is not a little, quite different from that. Quick thoughts on, watch out, people that were investors, and companies and investors both should watch out when they, as to rush to thinking about SPAC as an alternative.
No, absolutely. I think SPACs were extremely topical just before the SEC came in and put a sort of dampener. And I think we're seeing some of the SPACs that are listed out of Southeast Asia. Also, their value accretion has been, quite devastating, I think, for some of the investors. I think very quickly for Indian founders, you need to be cognizant of the fact that, share swaps, which is one of the things that you need to do in order to do a SPAC, is kind of restricted under Indian foreign exchange control restrictions. So you need to think about getting Reserve Bank of India approval, which is time consuming and not the most efficient way to do it. I think for young companies and for founders, you need to start thinking about this early, whether you want to externalize, have a whole core structure, have a business plan in place to consider which jurisdiction you want to actually have a holdco in place for. Either Singapore or Delaware is where we're seeing a lot of holdco structures being set up. That way, at least you can plan for a SPAC in 5 years or 6 years down the line. And you can always keep the option of your IPO in India also open, where you've got your operating companies in India and they can list on the Indian stock exchanges. So talk to your advisors, legal, tax, etc., as early as possible, and get all your ducks lined up before you even think about a SPAC.
Thanks so much, Karun. I think summary is clearly exciting times. I think there is a lot that's going to happen in this calendar year, and I think there is a lot of interesting businesses that can get built and built on top of what's already been done. Prashant, TCM, Ashish, Karun, and Rajesh, thank you so much. I think love the conversation, and I think again you guys are making a great impact to the broader ecosystem, and more power to you as you look to impact entrepreneurship in this year as well. Thank you so much. Ron, thanks again, and over to you, Ron.
Yeah, thank you. Thank you.
Enjoy the
Thank
panel.
you.
Exciting times indeed. Thank you so much.
Thanks, everyone. Perfect time. I'm
Thank
going
you.
to be the last one to board.
Thank you very much.
Thank you.
Bye-bye.
Bye bye.
With that, there's been an insightful day of